It's almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Another one. China's central bank announces a fresh rate cut as the growth slowdown worsens. A range of data over the weekend reinforcing concerns about the recovery. JP Morgan's global head of capital markets, Kevin Foley, joins us with his outlook as the Fed's outsized rate cut changes the investment playbook. And Sri Lanka's next president is left-leaning Anura Dissanayake. We speak exclusively to the chairman of the Colombo Stock Exchange about how he's viewing the leadership change. Japan is short. We take a look at where China is and how it's shaping up. Stocks pretty much in the money on the surprise cut to the prime rate to 185 from 195. There you have it. CSI 300 index up 0.7%. There is expectation, by the way, that the Fed's bold 50 basis point cut might encourage further easing in China. 10-year yield down. Sign traders are pretty much pricing in more monetary stimulus. Taking a look at where the yen is right now, 749.3. Now, we had that, well, pretty much prime rate cut. We also had a higher fix, perhaps an indication that the Fed is trying to deter the yuan getting to 7 too quickly. So, pretty much this comes as concern around China's growth worsen, with latest data showing governments have cut spending, while the youth jobless rate climbed to its highest level this year. Meanwhile, Bloomberg is reporting the U.S. is planning rules that would ban Chinese hardware and software for connected vehicles as soon as today. And President Biden has been caught on a hot mic at a diplomatic summit saying China is testing the U.S. and its allies in the Indo-Pacific.
We believe Xi Jinping is looking to focus on domestic economic challenges and minimize the turbulence in China diplomatic relationships, and he's also looking to buy himself some diplomatic space, in my view, to aggressively pursue China's interest. China continues to behave aggressively, testing us all across the region.
Let's dig into China's headwinds with our Chief North Asia correspondent, Stephen Angle, who's in Shanghai, covering the IBLAC gathering of top global firms. Also with us is Matthew Chabron, co-founder of TKO Capital, a global group which manages more than $50 billion of assets. Steve, let's start with you. What were what's some of the key takeaways, your conversations in Shanghai? What are you hearing in particular about that step up on stimulus?
You know, the slowdown in China wasn't specifically talked about in great detail in the big open sessions, or according to Jens Eskelund, the European Chamber head here in China, who I spoke to earlier. He says it wasn't really discussed much behind closed doors either. It was more about the areas of cooperation in green tech and other new economy, industries that foreign business leaders can potentially partner up with the local government here. That's what IBLAC or IBLAC is intended to do, to find areas to co-invest. But again, it was on the minds of everybody, and it was almost prescient of Sir Martin Sorrell to say they need to have more stimulus in this economy right now because of the moves we've seen with further easing by the PBOC, and also announcing today that perhaps there's going to be even more measures. Pan Gongsheng and two other top financial officials will be holding a press conference tomorrow. They're not calling this to announce nothing, right? So there will be some sort of stimulus we are anticipating. But this is what Sir Martin Sorrell had to say about the need for stimulus right now.
I think the pressure is intensifying, and the thing I'm looking for is for the government to change their stance here and be a bit more expansive, because they do have wiggle room. I'm looking for a bigger step because they do have flexibility on interest rates and lowering them, and they do have flexibility with central government budgets, not local government, but central. So they can spend a bit more money. So that's what I'm looking for. I'm looking for a little bit of a reversal in the policy. In the absence of that, I think it continues to be quite tough.
Quite tough indeed.
And Steve,
he says the Fed's 50 basis point cut gives the PBOC perhaps a little bit more wiggle room.
Well, that's right. And the other factor, of course, the property sector. You spoke to Rio Tinto's chairman on that topic and possibly the possible impact on commodity demand.
Yeah, absolutely. I mean, look, there's no secret that one of the main pillars of past economies here in China has been the property sector. It's been in the doldrums now for several years, and Dominic Barton is the chairman of Rio Tinto. Obviously, they have for years sold iron ore for steel making here in the Chinese economy, very much tied to the property sector. And he says the downturn in property as one of the main pillars of this Chinese economy in years past is not over and perhaps is going to last a little bit longer. This is what Dominic Barton told me in an exclusive interview.
Key thing is unlocking the consumer. Right. And the challenge with that is you've got, with property prices going down and people having a lot of their wealth in property, they feel less wealthy, and we're seeing the effect of that. I think the property restructuring probably has to continue. I don't think that can change. There's a process they're going through. I think the issue is how do we give people, the consumer, the confidence about where things are moving. Obviously, stimulus programs and so forth are music to people's ears, but I think what we have to understand is there's a deeper restructuring for growth that's going on.
Clearly, the property downturn and the steel issues in China has lessened the demand for iron ore. So there's a surplus in iron ore. But he also told me that these green technologies need steel. Wind turbines need steel, and other, obviously, innovations will need that iron ore going forward. But also copper as the energy transition globally intensifies. Haslinda?
Stephen Angle, we thank you so much for that. Let's get to our guest. We have Matthew Chabron joining us here in the Lion City. Your take on how it's looking for China's economy. We're seeing all these measures coming up. Is there a sense of urgency finally or not?
Well, good morning, Haslinda. Thanks for having me. I mean, there's a lot of things we just heard, in a matter of 5 minutes. It was pretty dense. And a few days after the Fed, action, I think what we are witnessing right now is that many central banks are looking for some excuses, if I may say, to give a new price to liquidity. I think that what we've been seeing for the past 10 years now, effectively this abundant liquidity everywhere. And when it comes to China, they benefited from a lot of foreign investments. Now this money is moving out. Mr. Sorrell just mentioned about real estate. And what's happening right now, I guess, is effectively a perfect moment for central bank and for the PBOC, specifically to say, okay, we might not be giving you a new risk premium indication, but we give you a sense, that there is, more liquidity or potentially more liquidity. Let's see whether, this stimulus package, is coming or not. But I think we're coming down to some very basic, finance, corporate finance 1.0 here is effectively what's the cost of liquidity.
The thing is, we've seen massive outflows from China and on the back of that, from Hong Kong. Yet you're here from your trip to Hong Kong, setting up a new office. I mean, what's the thinking behind that? Well,
that's actually at the core of the TKO DNA. Create, don't compete. Haslinda, we opened our office in Singapore 10 years ago at TKO. We're celebrating 20 years, this year. And when we came here 10 years ago, a lot of our competitors were actually all in, on Hong Kong. And today, to your point, we see that the flows, the outflows, are very different. And that's when we took advantage of effectively going there. There are many drivers, to that. We're primarily a European-based asset manager with a portfolio of very, very interesting, companies, high growth company who are looking to effectively come into the wider Asian market, Southeast Asia, obviously, but China. It's a very good timing to be offering some alternative, to maybe more historically, maybe some U.S. managers, and the U.S. companies. The whole situation, is great for Southeast Asia, I believe. And at TKO, we're really looking at the whole market with our presence in Singapore, in Korea, where we've been 5 years, in Tokyo, and now, in Hong Kong, to be able to best serve not only our investors from a capital formation standpoint, but also our portfolio companies and the people that we're invested into.
First, talk to us about the opportunities that you see when it comes to China. The government is really trying to get capital back from the international market, and it is trying to get capital to areas like their innovation, their technologies. I mean, how are you assessing that?
That's right, and that's actually what we've been witnessing for the past 12, 18 months. In our discussion with the large asset owner, in China, who've been traditionally some very big asset allocators, some large LPs. What they're interested right now is no longer just to give you a check and you go, Mr. Asset Manager, and deploy my money, and we'll catch up, in 10 years. What they're looking for is really this two-way flow, where the portfolio companies that we invest into, that we finance globally, but specifically as far as we're concerned, a lot in Europe, could then in return, come back into China to effectively bring some expertise, make up for some part of the domestic slowdown that we are seeing. And the dynamic is very different from what we used to experience. And in that respect, we think it's a great timing. And what has been happening between China and the US and this overall dynamic is certainly creating for many of us, here in Singapore, in Southeast Asia, ourselves, in Europe, to take advantage of the
But the question is, do you trust China's move? Do you trust its policies will remain the same? It's been going out to say that, we want to ease the curbs on IPOs, for example. Is it enough to encourage you that, the environment is changing and it will stay that way?
Oh, I mean, the reality that at the end of the day, the market is always right? And what we've been seeing lately is that, speaking of the IPO market or others, even the debt capital market, and we all know that the property segment has been the biggest beneficiary, of this debt ballooning. We know that right now the capital markets are fairly inefficient, right? I mean, on your program earlier on today, they were talking about IPO in the whole region, and we know that the equity capital market, the debt capital market has been less efficient than they used to be. So that's where the private capital has a huge opportunity. And whether or not you trust the government, as far as we are concerned, it's about effectively at the micro level being able to asset select those companies who want to take advantage of the market share they can build in China. And on the other hand, effectively some Chinese institutions looking at investing abroad, they can do less so in North America, in the US right now, and that's where we're trying to take advantage of.
You talked about private capital. Private capital fundraising in China actually hit a new low in the second quarter. What would it take to reverse that?
Well, deleveraging. I think that deleveraging, is probably item number one. Then effectively confidence. Investors, need confidence, both way. I think that there are still some part of the market that have not repriced fully. We mentioned real estate, obviously, is a big one. There will be, and whether or not, we see the full effect, there will be some pain, supported, by the market. But like any cycle, and particularly for the fully levered assets, that will come to at some point, you will come to a tipping point, in the value, and that will be the right moment to step back in. That's why, we are trying to get ourselves ready. I mean, Hong Kong is a great market to be following right now. Where only, real estate is always a lagging indicator, because when there is a stock market crash, it happens overnight, right? For the real estate, by the time you swallow all the inventory and the repricing, you need people to be able to take the pain.
Real estate, along with the financial markets, have seen regulatory crackdown. Are you still worried about that?
You cannot really price, regulatory changes, because unfortunately, and we see that across the world. I mean, China is a specific case, but right now, many times we're debating around, the U.S. election and what can happen, one way or another. As asset manager, as risk manager, for us, it always comes down to the asset selection. We own private assets. In that respect, we cannot sell the asset overnight by looking at a quote on Bloomberg. We have to be able to live and every Friday night go home with our all inventories, and for the next 5 to 7 years, live with that. So, real estate as an asset class is one that we've always liked, at TKO. It makes up a third of our assets globally. It's still relatively, early here in China, in Singapore. Here we've been managing publicly traded REITs, as a matter of fact, investing in Europe. So we've always looked at taking advantage of the local technology to, once again, best serve their clients.
All right, Matthew, hang tight. Matthew Chabron of TKO Capital, he is sticking around. Well, still to come this hour, we'll have exclusive conversations with JP Morgan's Global Head of Capital Markets coming from the bank's annual India Investor Summit. Plus, the Colombo Stock Exchange Chairman will be joining us after the nation elects a new leader. Keep it here with us. This is Bloomberg. Welcome back. And we know that markets traders still mulling that jumbo 50 basis point cut by the Fed. What will it do next? We know that yields pretty much across the U.S. Treasury curve on Friday morning rose across the board. Taking a look where we are right now, we have 2-year bond futures at 104.30, 5-year bonds at 110, and 10-year bond futures at 114.67. In terms of the dollar, at 12.24.18. Now that the Fed has started cutting interest rates, traders are finding it challenging to place bets on the stock market. The U.S. economy is growing. Equity indexes are hitting all-time highs. Corporate earnings are expected to keep expanding. So, where are investment pros looking instead? Let's bring back Matthew Chabron, co-founder of TKO Capital. First off, 50 basis point cut. Some say it doesn't matter whether it was 25 or 50. Trajectory is it is going lower. How much more are you anticipating?
Well, I would be prepared to challenge that, actually. I'll be prepared to challenge that. I'm based in the US, Haslinda, so I can tell you that there is some sticky inflation. There is some sticky inflation. And, this move, the 25, 50, in the grand scheme of things, the reality, as we were saying earlier, is that today we have to operate, once again, as asset owners, asset managers, asset allocators in a world where effectively the risk-free rate is no longer 0%. It's not going back to zero anytime soon, absent any other big external, surprise. And right now we have, once again, to play with that. So do they have room to go further? Obviously, we've got this election, coming up. If I may, I think the Fed has always been a political tool, very different from the ECB, certainly the BOG. We just talked about, China. It's always been a political tool, and there would be a political agenda depending on the outcome, of this election. So. Traders, short-term money manager will have to effectively factor that in. But once again, in the long term, as private manager, it's a blip in the assumption that we have to make.
The thing is, markets are looking at 2.9% by mid-2026. Some say perhaps the Fed could get there much faster. Your take?
I mean, it could, but once again, as we were saying earlier, I think they're just giving you the price of liquidity. Our job, I think the traders you were referring about, our job is to rightly price the risk premium. And that's a totally different story. Because I think despite all-time highs in the stock market, I don't know whether you agree with me or not, but we probably are at the all-time risk environment globally, from a macro standpoint, geopolitical. And where is that reflected, in asset valuation? And I think our job, Fed is one component of the overall equation, the base rate is one component, but our job is to properly price the risk premium, and I think that some markets might be mispricing it right now.
All right, so there is currently a divergence in terms of monetary policy. Yes, the Fed is cutting. We have China adding stimulus. We have Japan and Brazil raising rates. Where do you see the opportunities from that divergence?
Well, that's, it's a perfect scenario for asset pickers because you're no longer just buying the trend, you have to do the work. And then that's when you have to do the work that you can be extremely discriminating. not only in your performance long term, in your client satisfaction, long term, and effectively, yes, people have to come down, to do the work. And once again, for private markets, you have to be multi-local. You just not do Asia from London. You don't do the US, from Singapore, and you need, this footprint. And we kind of like, this environment.
So what are you doing specifically in Asia? When we talk about Asia, of course, we have to draw a distinction. It's a huge market. Yeah. Southeast Asia, for instance. India is the other part of it. Yeah.
So we've been in Singapore 10 years, as I told you, and we picked Singapore as our hub, when we established here. Then moved to Seoul, Korea, to Japan, right now, Hong Kong. And we really had, three objectives. One was, to promote the brand and the investment solution that we could offer to asset owners, in the region, who've been, great allocator to the asset class. The other one was to effectively convert that, in fundraising. And today, starting from zero, it's roughly 10% of our AUM base, coming from the region, with some untapped market that we believe that are going to be contributing. And the last one was effectively to deploy some capital. Now, there's no shortage of capital, and at TKO we had no pretension, to challenge, the incumbents. But what we think is that we can bring some expertise, that will be extremely complementary. That's what we've been doing, over the years. I mentioned, real estate. We just announced a few months ago, private credit, which is, big 40, half of our AUM, in credit in some way, shape, or form. We just announced, this partnership here, and in this environment, that's a perfect asset class for investors to compound.
India, it's been euphoric.
Yeah.
It's time for a correction, some say. Yeah. Valuations are just through the roof, 20 times, PE. Like, do you still get in?
I'm back to, my supply demand, imbalance. What you lost in China, you gain in India from a flow standpoint, and somehow, a bit in Japan. But it's a different, it's a different story. So I think everybody agree you had this massive flow of capital. Again, leaving China, getting into India, valuation, once again, it's a relatively closed market, right? In India, despite being a huge market, we at TKO played, this market on some minority private equity play in some very significant consumer, I'm thinking, broadcasting typically investment. But to your point, right now it's purely driven by the supply demand and the inflows. One needs to get down, to fundamentals. On a relative basis, India is a very interesting market that we are looking at. But once again, you need to remain extremely discriminating.
All right, better be careful. Overstretched markets. Matthew, good to have you with us. Matthew Chabron of TKO Capital. Plenty more ahead. Keep it here with us. This is Bloomberg. And here are some of the top tech stories we're following. Bloomberg has learned that Apollo Global Management has offered to make a multi-billion-dollar investment in Intel. Sources say the alternative asset manager has indicated it is willing to make an equity-like investment of as much as $5 billion in the chip maker. We're told nothing has been finalized and the size of the potential investment could change. That development comes with California-based Qualcomm set to be floating a friendly takeover of Intel in what could be one of the biggest ever M&A deals. Sources say Qualcomm has been speaking with U.S. regulators and believes an all-American combination could allay any antitrust concerns. We're told also Qualcomm hasn't ruled out buying or selling parts of Intel in a combination. And Morgan Stanley is reportedly facing a regulatory review over a sell order for SK Hynix shares placed before it published a downgrade report. Yonhap says Korea's Financial Supervisory Service is planning to look for any unfair acts related to SK Hynix trading. Shares of the chipmaker tumbled more than 11% last Thursday after Morgan Stanley slashed its price target and cut its rating. Well, up next, we're heading back to JP Morgan's annual India Investor Summit for an exclusive. Keep it here with us. This is Bloomberg.
I'm a global global perspective is that a lot of MNCs are actually going and raising, getting the Indian subsidiaries listed, or actually trying to also see how they can use that currency to deploy that in terms of the valuations that you see in the Indian market. So I would say that M&A outlook is looking better, but given the equity capital markets are also pretty active right now, we see the table turning in this coming year in 2025.
And that was Navin Wadhwani, head of India investment banking at JP Morgan, speaking to us just a short while ago. Of course, India starts trading in about 15 minutes from here. Let's do a check on how futures are pointing right now. Remember that this is a market that's gone gangbusters, persistent euphoria with overseas funds in particular piling in right now, marking a strong return to the $5 trillion market. Foreign funds pouring almost $9 billion this quarter, bets on policy continuity with Modi in his third term in power. Nifty futures pointing to higher open, up by 0.5% right now. Indian rupee at 83.5737. Now, the biggest financial firms in India are in a frantic rush to court investors in second-tier cities. That's as the country's economic boom puts more disposable money into the pockets of everyday Indians. For more on this, let's bring in Bloomberg senior editor Manika Doshi in Mumbai. Manika, flush with cash, it seems, this market.
That's right, Haslinda, and it's been a slow revolution to start with, but has picked up incredible speed over the last 3 years. And I'll just give you a few data points that are very interesting. Every single PIN code in India has an investor now with money in India's stock markets. 1 of 5 investors now in India is a female, and the median age of investors has been slowly coming down. Today, it's about 32 years. 40% of India's investors are below 30 years. It was about 39 years just before the pandemic. So you can see the change in the demographic of the Indian investor. And as you pointed out, it is this new young investor that's channeling more of his or her household savings into India's equity markets, either through systematic investment plans in the mutual fund category or directly into stocks. There's also futures and options that is driving this big bull run that we're seeing play out in India.
And what a bull run, Manika. Hang tight. Let's bring in Kevin Foley, Global Head of Capital Markets at JP Morgan. Kevin, I mean, irrational valuations. That's fair to say. I mean, what do you make of it?
Oh, good morning, and delighted to be speaking to you from our 9th annual India Investor Summit. We're going to have over 450 investors in the next 2 days, 90 companies. We're excited about the energy around here and going to be talking a lot about the markets. So obviously, I think that we've had a good run in the markets here in India. We expect that's going to continue. When you look at the growth profile of the country and the secular trends that are happening, it's obviously a very attractive market as you're seeing investors globally out looking for growth. When you talk about the retail trends of investors coming into the market, well, you're also seeing EM portfolio managers globally who are underallocated to the Indian market, also looking to allocate more capital to this part of the world.
Are you not worried at all when you take a look at rich valuations among some sectors in particular? What might they be?
Well, I think you can look, you have a lot of debate about valuations, and you're going to go sector by sector, but you continue to look at the growth profile for the country as a whole, and you look at where the economy is projected to go over the next 5 to 6 years. There's a huge opportunity. And when you look at interest rates coming down, that's also going to be putting a push on look for growth. So we think there's a lot of arguments to be made about the justification for those valuation multiples. And we're going to probably see some consolidation here over time, but we do expect growth to continue to drive things.
Kevin, hi, this is Menaka in the Mumbai office. Welcome to a rainy city this morning. Are you seeing new investors come to India, both in the equity capital markets, which the momentum seems to have slowed, even though the interest remains very high, especially also in the debt markets, given what's happened with India's government bonds and their inclusion in the JP Morgan Global Bond Index?
Yeah, I think you've definitely started to see a little bit of stabilizing of some of the trends we've been talking about. But we do think they're going to resume over time. Again, as I said previously, that the growth profile of the country is going to continue to attract capital. You're going to see the benefit of the Fed cutting rates in that global hunt for yield. We think that's going to benefit from a fixed income perspective. And then from a just overall equity, as I mentioned, that the portfolio managers globally, EM portfolio managers that is, are underallocated in the space. So we think there is going to continue to see capital flow into the markets here.
Which areas look most interesting to you, where you think the prospects are the best? We've had a great couple of years for IPOs. Block deals have been, again, a big area of excitement and activity. M&A maybe not as much. What stands out to you?
Well, I think there's obviously the benefits from the supply chain shift that's going to have an impact on manufacturing names. You've obviously got the push on clean energy, which the country is well positioned for. And, you overlook at the infrastructure, a lot of investment going into infrastructure. So you look at those three areas, it's going to be a huge opportunity. There's a lot of outputs from that. We're going to expect to see capital continue to flow into those sectors, and they will have good growth prospects.
Kevin, the perpetual question is China versus India. China seems to be trying to get its act together with that rate cut that we saw today. I'm just wondering how you're assessing the two markets right now.
Well, we look at both markets. You've got to be exposed to. They're obviously two huge economies. They're going to continue to grow. So it's not necessarily one over the other. There's going to be opportunities in both markets. So a little more momentum in India with what's happening with some of the secular shifts that are happening across the region. But both markets are attractive. We think it warrants being invested in both, and we expect to see the continued growth in both markets.
Kevin, from a regulatory point of view, a policy point of view, is there anything that still is yet to be done in India that could significantly up deal activity and investment activity by foreign investors?
Well, I think the number one thing is liquidity in the markets, and we've seen that, right? We've seen average cash trading levels go to 17 billion a day. That's up threefold from where it was pre-COVID levels. Liquidity is going to get more liquidity. That's going to help attract more capital into the region. And I think the country's done a lot of things to attract that capital from a regulatory standpoint, and we think it's going to continue to be support from that standpoint. There's also just the drive to find growth and find yield. Those two things away from a regulatory environment are going to be the biggest drivers.
Kevin, we've been talking about how hot this market is. In particular, its IPO market, the hottest in Asia. What challenges do you think it might go through against a backdrop of a Fed that's cutting rates?
Well, I think obviously you mentioned this about valuations and the justification for those multiples, the continued ability to grow, right? We've seen a little bit of slowdown, and whether that's going to become more severe as time passes, but the ability to drive that growth and justify those multiples, that's going to be the key. And I think that's going to be the debate we'll have over the next year as we start to see some slowdown. Markets everywhere are assuming a soft landing. The question is if we start to see that softer than expected.
You've struck a very bullish note for India, Kevin. Do you see any of that changing on account of A, slower rate cuts in the U.S., because India will follow with a lag, and B, the election outcome in the U.S., depending on who wins? Do you think those factors could significantly impact foreign investor interest in India?
So I think from an election standpoint, that is going to depend on economic policy between the two candidates. I think we've got a pretty good sense of what each is going to go in the directions. There's some talk about tariffs. We'll see how those things happen. Those could obviously be a headwind for markets depending on which direction they go. I think also from a standpoint of from the Fed cutting rates, if the rate cuts aren't as rapid as expected, you could be making the argument that the economy is stronger than expected. So that's not necessarily a negative from a global picture.
Kevin, we've been talking about how the Fed made a jumbo cut. What does it mean for Asian bond borrowers, you think?
I think you're going to continue to see money flow into Asian markets because there will be a global hunt for yield. As you're seeing money move out of some more developed markets, they're going to move in more emerging markets and just looking for those yields. Globally, we're seeing spreads very tight. We're near historic tights. Asia is no exception to that. So what we're just seeing investors and lenders go out and seek absolute yield, and that's what's the emerging markets are going to benefit from.
Do you think investor appetite has changed, Kevin, on the back of that?
Not as of now. I think that there's still a lot of dry powder out there. It's still trying to find a home. It's looking for opportunities to put it to work. Most investors have bought into the concept of a soft landing, and they continue to just put money to work.
Kevin, thank you so much for that. Kevin Foley of JP Morgan, and of course, our own Manika Doshi. Plenty more ahead. Let's take a look at the Indian markets and how it's shaping up ahead of the open in about 5 minutes from here. And still to come, we'll discuss the outlook for Sri Lanka stocks after the election win of leftist political outsider Anura Kumara Dissanayake. The Colombo Stock Exchange chairman joins us for an exclusive interview. This is Bloomberg. Welcome back. We're keeping an eye on the Sri Lankan rupee. That's after leftist candidate Anura Kumara Dissanayake won a tightly contested presidential election. He secured 5.74 million votes in the country's first ever runoff. Best known in Sri Lanka as AKD, Dissanayake campaigned on a platform of clean governance and combating corruption. He's also promised to renegotiate loan conditions under the country's IMF bailout. We'll also monitor Sri Lankan stocks once trading starts at the top of the hour. Now let's get reaction now from Dilshan Warsasekara, chairman of the Colombo Stock Exchange. Dilshan, good to have you with us. How concerned are you about this government change?
Hi, and thank you for having me. We are not concerned at all. I think the people have spoken. Sri Lanka has a very strong tradition of having a vibrant democracy. We are the oldest democracy in Asia. Changes of government have been a thing quite familiar to the public. Over the last 10 years, we've had 4 changes in government. But I must mention this has been one of the most peaceful elections that we've seen historically. The people have spoken. They've given a mandate to the new president-elect Anura Kumara Dissanayake. And from a market's point of view, we are quite confident that Sri Lanka will still continue on the growth trajectory and the recovery journey that it has been on for the last 24 months. So to answer your question, I am not concerned.
But the thing is, Dilshan, AKD is not a tested politician. Do you think that investors, international investors, may be concerned even if you're not?
So I think we'll have to wait and see in that respect. You would acknowledge that Sri Lanka for the last 2 years has been on a journey from default into recovery. So the foreign investment sentiment hasn't been great over the last 24 months because we are a country in restricted default as we speak. So I don't think that'll really have too much of an impact. If you look at market turnover levels, we've seen for the last 3 to 4 years, turnover being dominated by domestic investors. So even as we speak for this year, we have over 85% turnover being dominated by domestic players, and the foreign investors really playing a much smaller role in the market dynamics. So I don't think that there will be a great impact, but it's something that we will all have to wait and see.
What's been clear is that AKD wants to review that $3 billion IMF deal. This deal, some say, has been crucial to stabilizing the economy and could lead to further growth. What do you make of the possibility of that IMF deal being upended?
So I think just a clarification that even AKD did come a few weeks before election and clarify that his stance or his party's stance is not to cancel or not to revoke the IMF program, but only to renegotiate certain conditions of the program going forward. So I don't think we are facing a risk of revoking the IMF program. However, I think the new government may want to consider certain parameters, thresholds that have been agreed in going into the future. So no, I don't believe there's a risk of us cancelling the IMF program. I think it's pretty crucial that Sri Lanka sticks broadly to the reform pathway to the IMF program. And we expect the new president-elect and his party to broadly stay in line with the program. I think that has been categorically stated prior to the election because there was some uncertainty. So it's only that there may be a few parameters that may be renegotiated going forward. So I don't think we run a risk of a cancellation of the program.
But despite that, investors are nervous. They're looking out for policy signals. What are you hoping to hear in terms of policies?
So I think the markets really hope for consistency. The good thing is we've got a new president-elect who has a 5-year term. Going by what he has spoken of prior to the election, he will dissolve parliament and call for general elections. That could be held within a period of maybe 6 to 8 weeks. So going in probably to the end of the year, we would have general elections also completed, and then hopefully a government that has a full 5-year term. So I think having consistency in policy for a 5-year cycle is important. We have not had that for the last 10 years due to changes in governments and changes in policy. So I think from a market's perspective, we all hope that we will have consistency in policy for the next 5 years. And the president-elect has a very good chance of now building upon this success to form a government and then govern the country with policy consistency for the next 5 years. So that's what markets are hoping for.
Right. Delchon, talk to us about foreign activity in Sri Lanka. We know that back in 2018, it was a 50-50 contribution in terms of local and foreign. When do you expect to see that again?
Sooner than later, I hope so. But you're quite right. I think if you look 2018 to prior, even if you go back 10, 15 years prior to that date, we've historically had a 50-50 contribution from a foreign and domestic point of view on turnover. However, after the 2019 April bombings, COVID thereafter, that dynamic changed quite a bit because a lot of the foreign investors pulled out of the country over macro concerns. And we've had, I think in 2021, turnovers dominated 95% by domestic players and only 5% foreign. That trend has slowly but surely recovered. Like I said, we currently stand at about 85-15. So we've seen increased activity in foreign investment flows over the last year, 18 months or so. However, definitely not back to the levels of 50-50. I think partly the reason for that is that we are a country in restricted default status. So you're not going to have foreign funds, portfolio managers being able to allocate investment flows to the country when it's in RD status. Now, I think one thing the president-elect inherits as he comes in is that we have completed the debt restructure, both domestic debt as well as foreign debt, with last week the government announcing reaching finalization or agreement in principle with the international sovereign bond holders or the commercial creditors. So that completes the entire restructure process. We believe that this would give the incoming president added advantage, because he's inheriting a government that has now cleared itself from default, and hopefully very soon thereafter gaining a rating upgrade.
You're
we believe
painting
that
an optimistic view of the country, Dilshan. How optimistic are you the country can get to 3 to 5% this year?
Very optimistic. We've recorded 5% growth for the first 6 months. I have no doubt that we will continue in that path, and we will reach 4 to 5% positive growth for 2024.
Dilshan, thank you so much for being with us. Dilshan Weerasethra, Chairman at Colombo Stock Exchange. Plenty more to come. This is Bloomberg. And here's some of the top corporate stories we're following. TSMC and Samsung have reportedly discussed building new factories in the UAE to help satisfy soaring demand for AI computing. The Wall Street Journal cites sources saying executives from the Asian chip makers have visited the UAE recently to discuss major new operations. The Middle Eastern nation is aiming to become a regional hub and testing ground for AI. Elon Musk's social media platform X has backed down and agreed to comply with court orders in Brazil. A judicial filing shows that X has finally appointed a legal representative as required. Sources also say it's blocked accounts accused of disseminating hate speech and fake news. It could end a months-long clash that resulted in multi-million-dollar fines and a ban on the platform. And in the market, we're keeping an eye on liquor stocks in China in particular. They're gaining on the back of Maotai's share repurchase plan. Shares of Chinese liquor makers rising. As Citi says, Kweichow Maotai's share repurchase plan, its first ever, is a positive surprise. There you have it, Kweichow Maotai, up 0.6 to 1%. We have Wu Liangjie currently up by 2.5%. Elevated cash return likely to attract more long-term investors in what is a volatile market. We're also keeping an eye on Asian uranium as well as nuclear shares. Nuclear energy stocks following their overseas peers higher after Constellation Energy, which is the biggest U.S. operator of reactors, said it expects 3 Mile Island to go back into services in 2028, and that's to feed the power need from Microsoft. Paladin Energy currently up by more than 6%. Boss Energy surging more than 9%. Asian uranium nuclear shares gaining on that 3 Mile Island plans. In the broader market, this is how it is looking at this point in time. Asian stocks are inching higher. Take a look at where the gains are right now. CSI 300, China CSI 300 currently up by 0.7 to 1%. Gains for the benchmark in the Lion City higher by 0.5%, and Hong Kong shares up by 0.5%. The MSCI inching higher for a 4th straight session. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. Do keep it here with us.